Well, good morning, good afternoon, good evening, folks, and welcome to the Africa Early Stage Investor Summits. We have Zachariah George from Launch Africa with us today. And it's just going to be the two of us, Zach. My apologies to you in advance.
It's all good. Thank you. Good to be here, Jim.
Great. Well, let's start, first of all, with a quick introduction. Tell us a little bit about yourself and Launch Africa.
Thanks, Jim. Zach George, I'm a managing partner at Launch Africa Ventures, which is one of the top early stage VC funds for pre-seed and seed technology startups across Africa. Prior to this, I was a co-founder of a global accelerator called Startup Bootcamp, well, the Africa operations at least, for 4.5 years. And that was on the back of a sort of decade-long career at Wall Street, where I worked at two of the largest investment banks right after my Stanford MBA. But yeah, Launch Africa is, I believe, one of the catalysts for galvanizing early-stage investment to grow and scale the most innovative African early-stage technology ventures, sector agnostic, region agnostic, but with a common theme of helping founders with access to markets, capital, resources to help them grow and scale. So glad to be here.
Gotcha. And so my name is Jim Chu. I'm the CEO and founder of Untapped Global. And yeah, I think one of the big questions, of course, is with Launch Africa, you guys are one of the most prolific investors in the continent. In the last year and a half, you guys invested in how many companies now?
Yeah, we're sitting at, as of the end of October, we were at 68 investments across 15 different African countries. And we've been around for 13 months now. Our first close was in September last year. Yeah, 13 months now. Yeah, so it's been quite a ride, but very necessary for the continent, and we hope that this is just the beginning.
Yeah. And I want to emphasize that you focus on pre-seed and seed stage companies, so fairly early stage companies. One of the challenges for investing in Africa really is about exits. And especially with fund economics, being able to achieve high multiple exits so that you can make the fund economics work. How do you achieve that when you're dealing with African investments?
Yeah, so most VC funds globally tend to have between a 12 to 15 year fund horizon. So it's a 5 + 5 + 2, or a 7 + 5 + 3. Timeline from an investment, harvesting, and wind down period. That works if your LPs in your fund are mostly DFIs or large institutions that don't have a need for liquidity or need to see returns on capital within a certain time window. When your LPs are mostly individuals, family offices, and smaller institutions and fund of funds that have a requirement of a return 5 to 7 years, you need to really rethink your exit strategy, right? So historically, most funds have relied on IPOs or listings as the primary mechanism of exits, but we know how far and few those are. And then secondly, trade sales and M&A, and I use those as two different mechanisms of acquisitions, because trade sales, for those that aren't familiar with the term, is essentially vertical M&A, where a large corporate acquires a tech company. So a good example would be an insurance company or a bank acquiring a fintech or an insurtech. It's mostly for customer acquisition. The multiples in those investments tend to be smaller than horizontal M&A, which is larger fintechs buying smaller fintechs, or larger e-commerce companies buying smaller e-commerce companies. So we've seen a big pickup in M&A activity. But the reality is, even M&A takes about 6 to 7 years at the very earliest to execute, right? So part of our strategy, as a lot of people are aware, is the ability to realize pockets of liquidity at multiple investment rounds. So the average startup in Africa over the last 5 years has done anywhere from 7 to 10 rounds of funding, and I include all the bridge rounds in between prior to liquidity event. And those opportunities, those rounds provide a huge amount of opportunity to earlier investors to take liquidity and money off the table. And I'm happy to explain how the mechanics of those work, but that's a key strategy in our fund, is creating.
No, indeed. I mean, as an investor, we often call it the illiquidity premium with venture, right? The reason you're able to achieve the high returns is because of the longer term illiquidity, and being able to achieve shorter term liquidity even within 5 years is amazing. But I think one of the questions though is, with the economics of venture, and at least in the way it's carried out for the most part in the US, it's really all about the big wins, the blockbusters, which usually comes not even from M&As, it usually comes from the IPOs, where you're able to achieve the 100x, 200x multiples that basically lift your fund up. What kind of returns are you able to achieve with some of these secondaries? If I'm assuming you're talking about the secondaries in terms of liquidity events, what kind of returns are you able to achieve? And are you able to, with this broad base of investment, achieve the high returns that venture requires to be successful?
Yeah, I mean, so one of the problems that a lot of funds have globally, so for all the Sequoias, Accels, Lake Stars, and Planet Brokens of the world, there are 99 other funds that no one's ever heard of. The majority of VC funds in the US, by the way, never return even capital, let alone hurdle rates to their investors, right? So the strategy of overemphasizing or putting all your eggs in the basket of the 2 or 3 IPOs that you may have is a strategy that, in my opinion, and in our team's opinion, will not work in Africa, right? So
Indeed.
We've had one IPO in the last 10 years, Jumia, and that sort of teetered along. So one tech IPO in the last 10 years is not a good bet to make, right? So we will have more IPOs, especially with the prevalence of SPACs. We will have more of them, but I'm not in the camp of just gunning for those 100x returns through listings, right? It may happen in the US, but in Africa, it's not going to happen.
At least I think that's a strategy for failure if that's your main strategy.
Right?
But indeed, so the question though is, can you achieve the outsized returns that venture is looking for through a strategy that is not depending on these big exits? Of course.
No, absolutely. So when we look at partial exits through secondaries, we will not exit a transaction unless we're doing at least a 3x on our money, right? So
okay.
The moment we are able to see at least a 3x net on our capital is when we start doing partial liquidity, because we invest really early. So our sweet spot is companies that are doing about $20,000 to $50,000 in monthly recurring revenue, mostly SaaS and transaction-based revenue models, B2B and B2B2C. A lot of these companies, from a valuation perspective, they have valuation caps of between $1 million at the low end and $10 million at the high end when they're raising their pre-seed and seed rounds. The absolute lowest pre-money valuation at Series A, the absolute lowest that we've seen our portfolio companies raise at is 20 million, right? The absolute lowest. So if you just work the math on that, if you're doing a 5 million seed round from a valuation perspective, and you're raising at 20, that's already a 4x within a year. So we typically invest in companies that have a very realistic chance of doing an A round within 6 to 18 months of their seed round, which is, and as a fund, we lead.
So I would even ask a question though, is 4 or 5x even enough to make the fund economics work?
No, it's not.
The fact that,
no, it's not. But again, I'm talking, if you're doing a 4x in 1 year or in 1.5 years, you still have 5.5 to 6 years in the fund, right? I'm talking about getting your capital back plus your hurdle within 2 to 3 years of the fund, right? So essentially, you're completely mitigating your downside and leaving enough upside. So the problem with a lot of fund managers is they hold on to their positions for too long, hoping for a 50 to 100x. That doesn't happen in 5 or 6 years, right? And that's a problem. So the majority of funds end up extending their fund lives by 3-4 years because they haven't seen that IPO. And there's a lot of pressure on founders to list. So all I'm saying here is if you can make a 3x or 4x on your money within a year or within 18 months, we would sell a third of our portfolio, make a 2.5x, and leave the rest
for upside.
For upside. So I strongly believe that downside mitigation is almost as important as upside J-curves, and that's a key.
Switching topics a bit, let's talk about LPs and the increasing interest of LPs, international LPs in Africa. I'm assuming that you've seen that shift or seen that increasing interest. Love to understand from you what kind of investors you've seen that interest from where, and what are their motivations? I mean, obviously we all want to make a return, but there's always secondary, tertiary motivations behind those investments. What have you seen?
Yeah,
what's been the most compelling among your LPs?
No, absolutely. So our LPs are, 40% from Europe, 30% from the US, 20% from Africa, and 10% from Asia. The vast majority of our LPs, I think close to 80% of them are individuals and family offices. But what's interesting, Jim, and the other 20% are fund of funds and small institutions. We deliberately stay away from DFIs because we don't think that DFIs are a good fit at this stage, at the pre-seed and seed stage, because it's hard for DFIs to really understand things like unit economics and the LTV CAC ratios, et cetera, et cetera. It's just they haven't gotten there yet.
That makes very good sense. And if you're able to achieve the fund size without going to the DFIs, that's bravo
so
to you.
We're targeting between 25 and 30 in total fund size, and we're sitting at 21 at the moment. So we reckon we'll close that year. Yeah, thank you. But the interest is predominantly, and this is a very important point. We seek out LPs that have a strategic value add in addition to just their capital. So our ideal LP, if I were to paint a picture from an early stage fund perspective, is someone, either an individual or a family office that has significant connections to industry. So for example, retail, insurance, banking, asset management, clean tech, etc., that invests in their personal capacity, but can bring the commercial prowess of their company or industry to add value to our portfolio company. So a good example would be, a company like Kareem or Swivel has significant commercial prowess in the Middle East and North Africa. Now, those companies may not be able to or allowed to invest in funds like us, but the individual senior executives at these firms have no problem investing in their personal capacities, a couple of $100,000. Now, the fact that they have an upside in our fund portfolio companies makes them all the more proactive when our portfolio companies are looking at acquisitions, are looking at partnerships, and then they would naturally use their leverage in their industries to help that. So that for us is an ideal LP. Yeah. So we have, I'd say, more than half of our LPs fit that bill. One of our LPs was the CEO for almost 30 years of the largest asset management firm in the US. And, he's an LP in our fund, but any of our fintechs in the asset management industry that need ropes into the US, that particular LP is a key channel for it. So those are really powerful LPs that I think fund managers should look to get onto their cap table. And often those LPs add a lot more value than DFIs.
Indeed. Well, we're starting to end the near of our time. So one last question for you, Zach. What do the next 5 years look like in terms of venture, in terms of the kind of investors who are putting their money into funds? Are we going to see more local investors? In my view, one of the things that is still missing in the market is more local money, more local money that understands the local markets. Do you see that happening? And if not, how do we encourage that to happen?
Yeah, I think one of the things I've always said is local investors start off investing in angel groups, the Lagos Angel Network, the Cairo Angel Network, etc. So there is a lot of interest in local angel communities to start investing direct tickets into startups. But I think getting local investors in Africa to start investing into funds essentially will start happening once they can see returns, right? So a key tenet of our fund is to say, let's create liquidity, let's return capital to local angels in South Africa, Nigeria, Kenya a lot quicker. And that propels them to then invest into funds. It's going to be very hard to convince investors to start investing in funds unless they've had some successes as angels, right? There are some exceptions. Interestingly enough,
no, indeed.
Interestingly enough, in Europe, and this is an interesting point of debate, a lot of very successful professionals in Europe do not want to invest directly into companies in Africa because it's too far away from their expertise, and they'd rather invest in funds and then use funds as leverage to do directs if it fits your mandate. But in Africa, it's the opposite. The mentality is, I live in Lagos, I live in Nairobi, why do I have to invest in a fund? I can just meet the entrepreneur directly. There's an interesting dynamic where you see shifts in, what comes first, a direct or a fund investment. So, but I think in Africa, we're going to have to see a lot of direct investments first. Angels getting burnt, and then saying maybe the right way is to put it into a fund that does all the digging and diligence for me. And then I have the optionality to do directs on the side.
Of course, I mean, there's diversification, which is probably one of the most important aspects of a fund. Yeah. But, I second what you're saying in the sense that, especially for individual investors, I think the importance of early distributions for bolstering the fund, creating confidence, and encouraging more money to flow into those funds. So yes, let's get your LPs some early distributions. I hope to see them soon.
Yeah, thank you, Jim.
But with that, thank you very much, Zach, for your time. And final note is I heard you recently were in Italy. How was that?
Yeah, it was really good. I was at the Pope's summer residence for a Harambe Vatican summit for a few days. It's interesting how even organizations like the Vatican are now starting to look at entrepreneurship in Africa as a very strong alternative to the model previously, which was essentially aid, grants, and donations to charities. So a lot of minds, even in places like the Vatican, are starting to sort of turn and say, maybe there is a better way to support education, healthcare, renewable energy, agricultural products through innovation and technology versus just through aid. So a large part of our thesis was to plant the seed as to how a lot of cloud could change it. So it was very good.
And we're certainly preaching to the choir, both of us, but we obviously I think that's the way of the future. Support entrepreneurs, support entrepreneurship, and I think we'll achieve better results than the decades of aid.
And I think what Untapped is doing on the asset financing side is such a good complement to what the VC industry does, right? We couldn't do this without each other. So I think what you're doing at Untapped is absolutely fantastic. And any entrepreneur that has an equity play together with an asset financing play should definitely be talking to Untapped.
Yes, indeed. And, Africa, the needs, as we discussed earlier, the needs and the strategies for investing in Africa are different than what they are investing in the US. And if we don't recognize that, we're going to lose our shirts. So fund managers like yourself and companies like ours, where we've really localized the approach, I think that's a really important aspect of investing in new markets like Africa.
Exactly.
Zach, thank you very much for your time, and best of luck with getting those quick returns for investors. And I look forward to staying in touch. Thanks.
Thank you. Okay, cheers. Bye-bye.